I'm managing this fund for now more than 6 years, and in last 6 years never has been the case that I'm struggling with the ideas.
So these are very important, especially in a sectoral fund.
If I see it holistically, I believe that India will actually gain out of what all is happening currently. So many of the sectors, if you'll see, for example, cement, power, agri input, they are quite structural in nature.
I think yes, it's an enabler to GDP growth and a propeller too.
So I think this is one sector which is very well placed, and the best part is.
Hi everyone, welcome to the third episode of Fundamentals. This is Shaily Gang, Head Products at Tata Mutual Fund, and today we will be speaking about a very interesting fund, Tata Resources and Energy Fund. This operates in a very relevant space today in the context of India's growth story. And if India has to have a GDP growth of about 6.5 to 7%, this space is expected to remain very strong. Let's interact with the fund manager, Mr. Satish Mishra. He has carved out a brilliant balance between cyclical and non-cyclical businesses in this fund, also creating a good balance, a good mix of structural growth and global linkages, and spanning investments across the valuation chain. Hi Satish, glad to have you here and to be talking about this fund. So to start with, can you tell us about this space itself, the resources and energy, and the fund's balanced positioning, that I just spelled out.
Right.
Can you elaborate on that?
So Shaily, see, in this fund what we have done, this you can broadly divide it across three different spaces where we have invested. So one is definitely energy. Under energy, we invest into everything which can give energy. For example, oil and gas, coal, power sector. That's under energy. Second is under investments. What we have tried to do, we have tried to capture the cement space. That is under infrastructure. And third is under cyclicals. We are trying to capture cyclicals like metals, mining, chemicals, sometimes sugar, sometimes agri commodities. So basically the idea is that as you rightly said, structural and non-structural, or cyclical or non-cyclical. So many of the sectors, if you'll see, for example, cement, power, agri inputs, they are quite structural in nature. Yes. Whereas some of the sectors, they may be cyclical because of domestic demand supply equation or global dynamics. So that way the idea always has been that you keep a blend between all these three, and roughly at any point of time you will see that I'm not significantly skewed towards any of these categories. So it is pretty well balanced, 40 to 50% energy and 50 to 60% between, say, cement and other cyclicals.
Great. Thinking about the peers that are there in this space, we have pure energy funds, we have commodity funds, we have few other resources and energy funds also. How is Tata Resources and Energy Fund, our fund, how is this placed very uniquely? Is there a unique placement?
Yes. So how I'll put it is that, see, whenever we talk about any sectoral fund, normally most of the sectoral category you will see there will be one or two sectors where one will be investing. Like for example, energy one will invest into oil and gas and power. Commodities, mostly it will be related to, say, metals. But in this fund, you have 5 large sectors: oil and gas, power, cement, metals, and power. All these 5 are large sectors. Okay, so what happens? Chemicals is another one. So what happens when you have these 5 sectors to invest? So it is never the time that all these sectors are going through, say, bad phase. The key challenge for fund manager in any sectoral fund is that if, say, that sector is going through a bad phase, the fund manager has no other option. But here you have 5 large sectors. So in fact, I am managing this fund for now more than 6 years, and in last 6 years never has been the case that I am struggling with the ideas. So you always find ideas across the 5 sectors. So I think that is one very unique feature about this fund. That is one. Second, as you rightly said in the beginning, this fund is very well aligned with the India growth story. Like currently government is talking about investment share in GDP. Then again most of the sectors are aligned to that. In India we are talking about rising per capita. Again, that consumption portion will help many of these sectors. And even what happens in most of the sectors, sometimes global volatility impacts significantly. Whereas in this 5 sectors which I said, there are many sub-sectors. For example, cement, power, natural gas. These are sort of insulated from what is happening across global. So at many of these volatile times also, this fund is not so significantly impacted. And in fact, this is one of the key reasons. This fund is pretty old. It's more than 9 years, close to 10 years. And if you will see its performance across all the long time frame, 5 years, 7 years since inception, you will always find returns are very good because you have options across the 5 sectors to invest.
Yes, you can take your pick and sometimes go overweight on some of the part.
And there also what I always try to do, out of these 5, so what I have noticed that basically your sectoral weight discipline is very important to mitigate the risk. So at any point of time, you will not see any of these 5 sectors crossing say 35-40% of the portfolio. I'll keep a cap there. If say it is going to 30%, it will be well diversified across the subsectors. So these things I have followed over the last 6-7 years and it has really helped.
True. These are very important, especially in a sectoral fund or a thematic fund. True. Now, talking a little bit about the sectors in detail which are there in this fund, picking up power first. Lots is happening in the space, in the power space, in the energy space, and we read and hear a lot about renewables also, solar, wind, hydro. There we also read about hydrogen.
Right.
So can you give us a perspective on the mix of conventional energy resources and renewable energy resources in this fund?
Right. So see, in India, if you ask about the power generation story, power demand consumption, so again, as I said, these are linked to 2 things. One is what kind of industrial activities government is doing, and second is consumption at personal level. The best part with India is that government is also focusing on increasing the share of say capital formation, investment, and at the same time our per capita GDP is increasing. So consumption demand wise there is absolutely no challenge. Now what is happening in India, if you will look at most of the oil and gas space, for example crude, more than 70-80% of our crude we are dependent on imports. For natural gas, more than 50% is met through imports. So what is government is trying to do over there is, first they are trying to diversify it across the renewables, as you rightly said. So for example, if say you go 10 years back, there you will notice capacity wise more than 70% of capacities were based on thermal. So government is increasing the share of both. So capacities are coming both for thermal as well as renewables as well as hydrogen. Because India is a country, if you are looking for 6, 7.5, 7, this kind of range of GDP growth, and all these sectors are multiplier to GDP. So basically we are looking for 8 to 10% kind of volume growth. So in India you are going to see demand increasing, and all the 3, the hydrogen, renewables and thermal, all 3 will do very good.
I think yes, it's an enabler to GDP growth and a propeller too. I agree. Talking about cement, what are the demand drivers there, and how are we placed in terms of, let's say, capacity, existing capacity addition, utilization? Can you give us a perspective there?
Yes. So cement, I feel, is actually a very interesting at this space. Here, demand is completely domestic driven. At the same time, if you look at what are the drivers for cement demand, so one is all the government infrastructure activities. Second is the urbanization, premiumization, what we are seeing. And third is all the housing in villages. The best part in India, there is focus on all 3. Infrastructure, we are seeing government is really very, very serious. Urbanization, all the cities which are tier 2, tier 3, tier 4 are coming. At the same time, by Gram Awas Yojana, Pradhan Mantri Gram Prawas Yojana, we are seeing that even housing in a rural area, that is picking up. So I think this is one sector which is very well placed, and the best part is many of the cost here is dependent on international variables. For example, the energy price which is coming down, that will help. So like for example, at this point of time, I am quite overweight on this space because your demand is quite structural and cost, which is cyclical, is in your favor. So I think this is really very interesting space.
And so we've spoken about power, cement. Chemicals is another area where you invest, and within chemicals, what is it that you like? Like specialty or fertilizers, which is the agri input part.
Right. So see, in chemicals also, what I have done, like I have divided the portfolio into 3 buckets. One is commodity chemicals, where you are significantly exposed to what is happening in China. Second is specialty chemicals. Specialty chemicals is more aligned to what is happening in the developed economies. And third is agri input, which is more linked to the domestic situation, and which is also quite politically sensitive. So at this point of time, for example, you will see that for any government across the world, food availability is always a priority. So you'll always see that agri input is relatively less volatile in a times of what we are seeing. So in fact, at this point of time, we are more overweight on agri input as compared to specialty and commodity. But otherwise, in my fund, you will always see that specialty will be more than commodities.
Covering one more sector, which is the metal space. We know that there are ferrous and non-ferrous metals, and now the Build India phase favors cement, but then from that perspective, you would be overweight on ferrous metals. Then is that true?
Yes, absolutely. And in fact, there is one more variable to it. Say, for example, when we talk about ferrous is more related to infrastructure growth, and in China is really large in ferrous. So there, at the same time, our government has come up with a safeguard duty. Whereas if you talk about non-ferrous is more directly related to all the industrial activities, and there it really matters what is happening in the developed economies as well. So I think in the current context, there are less negative variables for ferrous as compared to non-ferrous.
Added to this, curiously, with the US reciprocal tariffs in discussion, barring power sector, of course, what is your view on the impact on these sectors, chemicals, ferrous metals?
Right. See, how I see the situation, it is always relative. Okay, so you need to see who are your competing countries. So you are competing with China, you are competing with all the Southeast countries, and you will notice that our tariffs versus these countries are significantly lower. So that way, I think, in fact, what I believe, like earlier also we saw this China plus one theme, and India is very well placed to benefit from there. So there may be some volatility in the near time, but otherwise, if I see it holistically, I believe that India will actually gain out of what all is happening currently.
Great. Nice hearing your views, on Tata Resources and Energy Fund, and happy investing everyone in Tata Resources and Energy Fund. This is one fund which is so well balanced across geographies, as we heard from Satish, very well aligned to government initiatives and in fact benefiting from them, and again very well diversified across cyclical and non-cyclical businesses, and underneath them the various subsegments capturing the value chain very beautifully, and also going overweight, underweight depending on the phase for that segment. So once again I would urge everyone to have a look at this unique fund, Tata Resources and Energy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.